Here we go again. Podcast, as you can see, I am solo again. What does that mean? Well, it doesn't mean it's good for Michael. In the last podcast, I did it solo because Michael had some car troubles, and I asked you what you thought of it being solo versus it being conversational based. And, was the response, you like me better? It seems to be. No, just joking. What everybody said, the feedback was they like both. And today, Michael is sick. And so I'm back at it. We're running it back, me solo. Today, we are covering real estate. We're talking single family. We're talking multifamily. A lot of data just came out that kind of highlights a lot of the challenges that the housing market is facing. I'm sure everybody feels it. Feels like home ownership is unavailable for millennials and Gen Z. So we're going to cover that today. We are going to start with overvalued, undervalued. Going straight into it. Single family homes in 2025, overvalued. Multifamily real estate in Sunbelt cities, well, it used to be an overvalued, but now it's corrected. So I'm going to go with undervalued. Fix and flip investing is completely dead. There's no flips going on right now. Millennials trying to buy homes under 300K, as you're going to see with the data, it doesn't look good. Single family rentals as long-term wealth plays. Well, the data looks pretty good, but I know all you feel this. We don't like institutions being on the home ownership side. So how do we get the American dream back? We'll talk about that. Multifamily REITs. This one's wild. Crazy returns. I'm going to say, I guess it's undervalued. They've had a great 2-year run. The lock-in effect. It's not overvalued or undervalued. It's the situation. It's been basically inflating the housing market. Buying in the Midwest, the Sun Belt, I've been telling you this forever. Don't do it. It's oversaturated. So overvalued, but it's correcting. So maybe there's a buying opportunity. Trying to scale a single family portfolio today, I'm going to give you the same answer I would have given you 10 years ago. I don't like it. Last, the American dream of home ownership in your 20s. I like it. It's just hard right now. So let's go straight into it. Let's look at some of the numbers. Here is the reality on the streets for single family from 2024 to today. We're still in a housing shortage. That's the reality on it. It doesn't feel like it's going to get any better soon. Hate to be discouraging, but this is what the numbers look like. January 2024, there were only 1 million homes on the market to purchase. Now, we did see a little bit of increase over the year. Now we have about 1.45 million homes on the market. So there's more supply today than there was last year. Here's the problem. If you look at the amount of homes on the market today versus 2019, way less. There were almost 2 million homes on the market in 2019 versus today's 1.45 million. So we've got some issues. NAHB says that we're short by about 1.5 million homes nationally. I think that's understated. I think we need way more than that. I'm going to make the argument that we need more than 1.5 million homes in California alone. Now, why is that? There's multiple factors. One, we have not built. I would say that's probably the biggest reason. If you look at all the building we were doing from, let's call it 2000 to 2007, we were building a lot. Post 2007, we haven't. We've had basically 15 years of trying to get back to, let's call it pre-financial crisis numbers. We haven't done it. So we have not added the supply needed for population growth for now, a decade plus. So that is what I would say is the major factor. And then you start adding on the other factors. One, costs are so high right now, right? You go through the inflation we did, that is going to make it more expensive. We've been in an environment of regulation, right? There's been a lot of regulation added onto development. That adds to the cost. And so we're feeling it. And then lastly, interest rates, right? Interest rates it's not an all-time high. Like when my parents love bringing this up, right? When I bought my home in the 80s, interest rates were double digits. I think my dad told me that for the house that I grew up in, I want to say his first loan, he was paying like 16%. So that's crazy on the interest rate side, but the values reflected it, right? I'm going to go out and say my dad's first home that I grew up in was probably $130,000 that he purchased in Southern California. So you could still afford buying one in your 30s. Today at 7%, you can't. Of course, there's multiple factors to that though. Now, here's interesting data. At a 7% mortgage, which is the highest it's been for our generation in a very long time, the home prices are still climbing. 2024, the median price was $379,000. Today, it's $414,000. So we have seen home prices go up. That's about 2 years of consistent growth. One of the factors at play right now is the lock-in effect. So the lock-in effect is 2% interest rates, right? Everybody who could locked in a 30-year fixed at an extremely low interest rate. And because of that, they're not selling right now. Why would you sell a home to then have to buy another home and pay 7%? It throws off all of your monthly numbers, so most people aren't selling. That is probably the biggest, no, it's not the biggest factor. It's a major factor of why home prices are where they're at today. I saw Grant Cardone talking about this. Grant thinks that when interest rates go down, home prices are going to go down as well. That's not normal. Usually what you see, remember 2021, what happened when interest rates hit the bottom? Prices went crazy. Why? Because on a monthly kind of outlook, you can afford a more expensive home each month. Well, his argument, and I kind of think there's some truth to this, once interest rates come down, how many people that are locked in that want to sell will start selling? If they do, you will see more homes hit the market. And what we're ultimately trying to get to is equilibrium. At what point are there more homes on the market than there are buyers, or even just a at par basis? There's 1 million people looking and 1 million homes on the market. We're at least at equilibrium. If homes go beyond that, we'll start seeing a correction again. Now, I'll just kind of fill you guys in on a little bet I have right now. I have a bet with a friend who is adamant about the housing market crashing. She thinks that the housing market is going to crash because it's just too expensive. And so this is our bet. It's actually all upside for me. I've been on this carnivore kick, you know that. And she is she's into fitness, and she thinks carnivore is stupid. So the bet we have is if the housing market in California does not correct in a year and a half, she's going carnivore, and she's going to love it. It's going to be so good. She's still hot on it not correcting. She's still hot on it correcting. I am not sure it's going to. We will see. But I actually do agree with Grant. If rates come down, we might see that. Flipping, home flippers. Flipping is completely dead right now. And there's a handful of factors showing why that's the case. One, if you're looking at the amount of people that are flipping today versus 22, so 2.5 years ago, it's down by about 32%. So the numbers are showing it, less people are flipping. Why? Well, one, it's really expensive right now. Two, when you flip, you have to get the value that you're projecting to when you exit, right? There's a lot more pressure for that number to be correct in a short amount of time. If the market basically flatlines, doesn't even have to come down, it might make it hard for you to sell your asset. So I think there's a lot of people that are looking at this moment going, it is too risky to flip a home. If anything does happen to values, I'm going to lose money. Here's an interesting one. I'm not a flipper, so I don't really pay attention to these numbers, but I thought this was fascinating. The average ROI on a home flip right now is 29%, which is a decade low. Now, 29%, when you compare that to what I do, seems extremely low. Why? Because in my perspective, home flipping is a lot more risk, right? You've got to get in, you got to do your business quick, and you've got to exit within that year typically. So what does that mean? You're not getting any long-term gains. You're paying way more in taxes. And because you're relying on the health of a market, if the market goes down, you can't wait it out, right? If you can't sell your asset, your holding costs start smoking your capital. Where when you do what we do, if there's a downturn during your hold period, considering you underwrite it correctly, you just don't sell. You continue to get the cash flow and you wait the thing out. That I have always felt is way more security. And so if you're starting to use your risk profile versus your return, 29% ROI for what I think is a lot more risk starts to not make sense. For the projects that we're doing, right now we're targeting somewhere around a 20% average annual return. And that's considering a long-term hold. So it gives you some, let's say, let's just call it less risk. An extra 9 points and you're going to pay an astronomical amount in taxes. I think that's probably why most people are not doing it right now. This one's for the millennials, and which is my generation, and Gen Z. And I just want to start by saying I don't like this. This sucks, but it looks like this is the reality of the situation. If you're under 30, you're not buying a house unless you have parents that are going to help you. Take the parents out of it, you just can't afford it anymore. If you're making $50,000 right now, you can afford less than 10% of the homes on the market. If you're making, let's call it $75,000, you can only afford about 21% of the homes on the market. Contrast that to 2019, that same $75,000 income, you could qualify to buy 50% of the homes on the market. So you can afford way less today. And I think this is where the big frustration's coming into my generation. I've been told that home ownership is the best thing and it's the American dream. What happens when a fraction of people can afford it? Well, that dream starts to go away. And you definitely start feeling this frustration with my generation when they start looking at, let's call it Gen X or baby boomers. Kind of feels unfair. How come you guys got to buy homes in your, early 30s and I've got to wait to maybe 45 to do the same thing? It's frustrating. Now, I think it's important to ask how we got here so that we know what the root cause is so that we can fix it and bring this back online. Now, what are the factors? Most people are going to tell you that it's the fact that home appreciation has gone up at a faster rate than income increase. And there's some truth to that for sure. But why has home ownership gone up so rapidly? If you took 2020 to 2024 out of it, well, the growth hasn't been that crazy. It's been about 5% annually. And you do want homes to appreciate faster than your, what should I call it? Your earning potential. Let's call it that. Home ownership or home appreciation has outpaced income potential or what you can make on an increased basis each year. You want that because a home is an investment. You want that to appreciate or outpace income potential, but it got to a point where it started going too rapid. Why? Well, here's the factors. Inflation is a big one. Why people say that you should invest in real estate as a hedge against inflation is because inflation, or a part of inflation, is cost of living. Cost of living means rent is going to go up. If rent goes up, that typically helps real estate investors, so it acts as a good hedge. So all this money printing we did post 2020, not good for home ownership. The interest rate issue. When you put interest rates at the floor of, let's call it 2%, and it's a 30-year fixed, well, that's going to lock in homes. The other one is building. We just haven't built. So there's a trifecta that is hitting this new generation, and it's painful. It absolutely is. If you look at NAR's estimate, they're estimating 780,000 affordable homes are missing nationwide. So we have to build. Now, everybody gives me crap for this one. I really don't know why. I always say that the way to solve the housing crisis is to add more units. And people give me pushback because they say, yeah, but look at the prices of the homes you're building. They're too expensive. For those that criticize, let's say, apartment buildings, they're saying you're building luxury units that are renting for, let's say, a one-bedroom, $2,800 a month. That's too expensive. The reason that's at play is because we're still undersupplied. So as you're building more units, You're not going to see a softening until you hit equilibrium and then go beyond that. That's where the correction happens. We just haven't gotten there. So I think you have to add more units. As you add more units, you will see things come back to normal. I think that's the way to do this. For millennials and Gen Z, another factor is because they can't own homes, they're renting longer. And if you're renting longer, that is putting more investment into long-term rentals and not into building and selling single-family residence. Now, moving over to multifamily. This is my world. There's some interesting data that is going to support what I just told you. In this last year, in 2024, we put on 440,000 new apartments onto the rental market. And because of that, we have seen a softening. So rent growth forecast for the year is down to 1.2%. That's pretty low. That is because there are new units online. You now have more options. If you add more options and there are basically more options available for the renter, that means there's going to be more vacancy for the owner. If there's more vacancy, what do you have to do to get people in? You have to compete with the apartments around you. That means you're offering concessions, you're offering discounts. That's when you see the softening happen. That's what we are seeing. So vacancies right now are still above pre-pandemic norms in many of the metros. The markets that are really feeling it are the Sunbelt markets. Those are seeing rent declines. That is because of oversupply. Saturation has hit. Now, vacancy, if we hit the point of full crash, we haven't. Vacancy is still too high for that. Your numbers for 2024 nationally, occupancy is at about 94%. That's still pretty healthy. If you look at Q3 of 2024, we had about 153,000 units, net units absorbed. Why is that? Well, it's still young renters and people priced out of the market. Renting is the only option. That's why occupancy is still relatively high, even though we've added so many units into the market. Investor behavior, what's going on? This one was shocking. So when you look at investing in multifamily, you have three options. One, you do it yourself. So you use your money to purchase apartments and you become an owner for that asset class. You invest with a group like mine, which is basically crowdfunding investors together. Let's call it syndicating an apartment. And you pool all these investors to then have ownership of an apartment together. And then you place a manager in control. That's commune capital. And then the third one is investing in a REIT. A REIT is something that everyone has access to. You invest in the public market for it. It's kind of a hybrid between a stock and a real estate investment. The stock is backed by real estate. You get liquidity and the barrier to entry is much lower. This one shocks me. Multifamily REITs crushed it in 2024. I was not expecting this. The REIT index is up 26% year to date, 10.3% for all REITs. That's kind of crazy. I was not expecting that. I thought REITs would be performing lower over the last 2 years. 10.3% is pretty crazy. Cap rates are flattening even as interest rates rise. This one I think is actually off. What we've seen in our real estate portfolio is cap rates have softened. We've seen them soften on the multifamily side by north of a percentage point. That is significant. That means the value of our apartments have gone down. So there is a softening. Now, what it feels like the cap rates have bottomed. It does not feel like they're going to soften anymore. So if I were to give you my outlook on multifamily right now, I don't think interest rates are going to go higher than this. I think we are at the peak of interest rates. And from this point on, I think they're only going to go down. If that happens, interest rates, in theory, historically, will follow, which means cap rates are going to compress. When cap rates compress, that means values go back up. So that's what I'm expecting. The other part of this is development has been at a standstill. So The only real projects you're seeing at scale that were in construction from 2022 to now are projects that started before the interest rate hike in 22. So if you started, you're finishing these projects. As far as bringing new projects online, everything's been sidelined. You have not seen development happen at the end, from the end of 22 into 23, 24, and even now in 25. It's non-existent. If that's the case, next year, we're probably going to feel what we've been feeling leading up to 22, which is a lack of construction. That's going to take a while to turn back on. So my expectation from this point on, if you see interest rates come down, I think cap rates are going to follow. The fact that we haven't built, I think we're going to be undersupplied for quite some time. You can make the argument that this is a really good time to get into the market of real estate investing on the multifamily side. We'll see what continues with REITs. I think this is a pretty good time to get in, though. The outlook for long-term investors. Today's pain could be tomorrow's gain. That's kind of what everybody says. So here's the hard part about investing. I think this is why people get frustrated with real estate investors. Because when we go through economic downturns, those are painful times, right? That usually means that people are losing jobs. If you're a small business, that means revenue's down. These are times that don't feel good. What usually follows is a discount of real estate pricing. And if you're a real estate investor, you want to buy at a discount. Same things at play with the stock market. If a stock is worth a certain price and the price goes down and you have the opportunity to buy at a discount, why would you not want to do that? You do if your lens is investing. Now, here's where I think everybody gets frustrated. If I'm sitting here telling you that prices have corrected and I think this is a good time to start buying, that means you're buying where other people are feeling pain. I understand that. Be mindful of it, but I'm an investor. Everything I put out there is basically education for investors. That's who I'm speaking to. If your view is how do I invest smart, I'm going to kind of say that this is maybe the best time we've seen in the real estate market to get in, probably in a very long time. Now, here's the forever conversation. What's better, single family or multifamily? I'm going to start with this. Let's take home ownership out of it. If you want to buy a home because you want to own where you live, you want to control, let's call it cost of living creep, and you don't want anybody calling you saying, hey, I'm thinking about selling my home and you need to find a new place to live. You get some security in that. If that's what you're looking for, go buy a home and don't worry about the best time to do it. If you can afford it, buy it whenever. You're not making an investment decision in this. You're making a life decision. Now, on the investing side, what everybody has been talking about forever, what is the best asset class to invest in? Single family or multifamily? Well, the reality, like anything, there's pros and cons to both. If you're looking at the pro of investing in a single family home, I would say the biggest one is it's cheaper, which means it's lower barrier to entry. Getting your financing is easier. So if you're going to get started, I would say most people feel like they're able to get started in single family, and multifamily is just a bigger hurdle. So I'm just going to go into that direction. I think you're right there. The numbers for single family right now look really good on the long-term side. Occupancy is at 95 to 97%. It has steady rent growth. And because people are being taken out of the ability to buy, well, demand's high. Now, this gets us into a bigger conversation. Should investors be able to buy homes? Okay, here's my outlook. Yes, I think investors should be able to buy homes because not everyone is always going to be able to buy a house. There are people that aren't going to be able to buy, that want to rent a home, that don't want to rent an apartment. So I think having a percentage of single-family homes open for rentals, that is a need. I think the bigger conversation comes down to the institutions. Should institutional investors be able to own an astronomical amount of homes, making it so less people who could be able to buy homes can? Yeah, I think that's a fair point. I think there's some merit in it. I would probably land on, let's see. Good thing I don't have to create policy on this one. Mom and pop investors, I think, should be able to buy single family homes and rent them. Your mid-sized firms, I think, should be able to own single family. I think the ones that probably should be taken out of this are like your Blackstones, your massive hedge funds that are buying single family at scale. Yeah, that number's probably starting to become large enough where the home buyer that wants to own a home can't compete with you. You're pulling inventory out that is wanted on the homeownership side. I would say that's probably where we're headed. And I wouldn't be surprised if we see legislation coming in the next 5 years that probably try to solve that issue. Now, here's some of the cons for building out a single family portfolio. And these are the ones why I have never done it. One, because the barrier to entry is low, there's more competition, and there's more competition with new investors. Whenever you're competing with new investors, it's like playing poker with people that don't know how to play poker. They don't know why they're betting. And so the people that actually know how to play are thrown off by the way they're betting, and it makes it really difficult to make smart moves. That's kind of at play with investors as well. Like if you know that you can't purchase a home over, let's say, $300,000 because the numbers just fall apart, and you have a new investor that doesn't understand how to underwrite a deal, and they're like, I want this deal, and they pay $375, you can't compete with that. And so that can be frustrating for an investor. The second part is scalability. It has always seemed like such a tough move to go find 30 properties, negotiate 30, contracts, get financing for 30 properties, have a property manager manage all these properties that might be in different locations. That has always seemed much harder for me than just buying one apartment that has 30 units. That means you have to negotiate once, you have to get your financing done once, and you put one property manager on your asset. So from a scaling standpoint, I've always leaned towards multifamily for that reason. The second one, and this is the big one, I have never liked that single family is valued off of comps and kind of emotion. Like you're not buying a home because of your cash flow that could come in and your total IRR. People are buying homes because they want to own the home they live in. And because of that, the way we get to our values are radically different on these two asset classes. If you're trying to get to a value on a home, you're looking at what other homes are valued at on a similar square footage in your neighborhood, and you're basically trying to get that. On the multifamily side, your values are entirely economic driven. It is how much revenue do you have coming in? How low are your expenses giving you a higher NOI? That NOI and the current cap rate is how you get to the value. So if you can run an apartment more efficiently, you get to control the value more like a business versus a comp-based structure. I have really liked that. It felt like I had more control when going into multifamily. And if I could operate a business better, well, we got to see the benefit from the value accordingly. So I've always liked it for that. Now, there are cons for multifamily, of course. First one, I would say, barrier to entry. It is more expensive to buy a multifamily apartment. It is much harder to get the financing. And because of that, you have to put in a lot of legwork first, educating yourself, building relationships before you even have access to purchase one. So it usually takes more work. It usually takes more time. I think for me, that's a pro because that means I'm making an investment at a point where I'm really capable of succeeding. But if you're trying to get in, that can definitely be a challenge. The last thing I want to talk about is kind of the moment we're in. This moment is not going to last forever. At least I don't believe it is. If you're looking at what the political conversation is, think about what a lot of politicians are talking about. They're talking about the housing crisis. They're talking about housing affordability. If they are all talking about that, that means that the amount of people that are saying we have a problem with housing and we can't afford it has made its way to the policymakers. Now, that means that the pressure is on for them to start sorting this out. Now, you could say that, okay, great, the politicians are in control, we're doomed. Okay, that's fair. Like, I hear you on that. So we will see what they do, probably what you should expect. Certain states are going to do this better than others. If we're looking at what we're seeing in, let's call it Austin, Texas. I've been talking about this one a lot. Austin, Texas deregulated and they made it easier to build. Because of that, they've added an astronomical amount of houses and units online, and their market is correcting. So I'm a big believer in get regulation out of the way and allow the market to do what needs to be done, which is incentivize the private market to build. If they build, they will solve this problem. You will see the correction. There are other states that are taking a different approach. If you look at California, people scream about the regulation all the time. It's true. It is harder to build a home or an apartment here than probably any other state in the nation, maybe except for New York. If we don't pull that red tape away, it's going to remain hard to build. I'm not sure we end up seeing equilibrium. So what I would probably expect to see for California politicians, they're probably going to create incentive for affordable housing, which basically is more subsidized housing. And kind of how that works, when it comes to apartment buildings, you have a cost, right? Let's say you are going to spend $1 million to build an apartment. If you're going to spend $1 million to build an apartment, where do you need the value for that apartment to be once you're complete? It's got to be north of $1 million. And how you get there is based on rents. If rent is high enough to support the construction, which is going to give you your after, let's call it stabilized value, and it is significantly north of $1 million, you're going to build it. But what happens on the affordable housing side is because rents are suppressed, you can't go over a certain monthly rent. If you build it for $1 million and your rents are so low, the value ends up coming in at like $800,000. So why would you build an apartment for more than the apartment's worth? You're not going to. And so what politicians have to do is they have to find ways to peel back red tape, create incentives so that once you build it, the value is actually higher than the cost. Something we're seeing right now in LA is they have streamlined the entitlement process. The way they've mainly done that is by removing CEQA in your entitlement phase. CEQA is, you have to get through on your entitlement CEQA, which basically makes sure that the preservation and protection of the beauty of California is intact. That adds 2 years onto your entitlement, maybe a little bit less. Let's call it 18 months. By wiping that out, you just got through your entitlements in, let's call it 6 to 8 months. That saves you a lot of money. The other thing they're doing is they cut back the fees on the front end. So now they're making it cheaper to get through your entitlement phase so that when you look at the net result, you're actually in a positive position. I'd probably say that you're going to see more of that. Now, what does that mean for the overall market? All right, now we're going to get into some ideological viewpoint. It's always been my perspective that when the government gets involved, the net result is it's more expensive for us. Like, the government cannot compete with the private market. It's always more expensive. So I have found that when the government gets involved to solve problems, it typically makes the situation worse long term. This one, we'll see what happens if California paired affordable housing where they're cutting back regulation and they also do that on the market rate product and you see both sides of it rise together. That's probably going to be the best approach. I think we end up in a healthy housing market if that's the case. What's the probability of California doing that? I don't put it that high. I tend to think that California is going to have a housing problem for the next decade plus. That's not very optimistic. I know. Hopefully I'm wrong. Hopefully politicians start feeling pressure that they have to figure out the regulation issue and we see this thing resolved. So that is the update for today on the housing market. Let me know what you guys thought. Did you prefer this solo podcast of me breaking down information for you? Do you still like the conversational piece? Do you want to see a hybrid? Let me know. I'm a man of the people. I want to do what you guys want. So let me know what you guys think. We will start giving more content to you. I hope this was helpful. I'm going to leave it with this. Don't be discouraged if you can't buy a house right now. The best thing you could do is save your money, figure out how long it's going to take you to get to a down payment, look at first-time home buying programs, and just stay the course. Don't get discouraged. Once you give up, you don't ever have the option of buying, even though it's difficult and most people around you are going to say you can't do this. You can. It's just hard right now. Let's hope things soften. Let's hope it gets easier. Let's hope some legislation changes. Thank you guys. Love you. We will see you guys next week.